Hello everyone and welcome to ACCA Financial Management webinar for March 26 attempt. I hope you all are doing well. Kindly confirm, is my voice clear and audible to all of you? Thank you very much for the confirmation. I welcome you all to this game changer webinar series for FM, yet another webinar from VIFHE's platform. So all the students who are appearing in March 26, these 2 days of webinar, one will be held today, one will be held day after tomorrow. Both will be very useful for you in terms of revision, practice, and for sure, because these are free webinars, everyone should watch it, and these will massively give you confidence before the examination. So let's begin. This is Rizwan Maniya, your tutor for FM. I have been into teaching since more than 18 years. I teach PM, FM, and APM, and I've conducted lots and lots of webinar for ACCA under the brand name of P2P. Lots and lots of students have secured positions in my webinars, sorry, in my classes by taking sessions with me. So there have been 63 plus positions so far that my students have secured in different papers of PM, FM, and APM. So I definitely want people to succeed. I definitely want them to pass the paper. And if you work really hard, you can be the next position holder in your part of the world. So now, how to remain connected with me during the webinar. So this is the chat box. You can see here where you just gave me the confirmation. This is the chat box where you can type the message and whatever questions you have, you can ask me using this chat box. I'll be very much happy to answer you. Plus, how to remain connected after the webinar. So there is a WhatsApp group, which is FM WhatsApp group. It's a global group where so many students from different part of the world are part of this group. So if you are not part of this FM latest group for March 26, kindly be part of that group. I will just ask the team to share the group link of that FM in the chat box. If you can see the chat box, the admin team will definitely share the group link in the chat box. So please make sure everybody is part of this latest group for March 26. In this group, I will be sharing the materials. I'll be sharing the materials that I'll be using in these 2 days of webinar. Other than that, certain important tips and tricks and revision things will also be shared with you people in this group. So please make sure you're part of this group. The link has been shared. All those who will watch these sessions in form of recordings later on, so for them, they can get this group link from the admission department, from the admission team. You can contact at this number and they will be happy to help you. They'll be happy to provide you the group links, the latest group links, and you can join those groups. On top of it, I am the principal here, so you can contact me at this number as well for any help, guidance related to this paper, not related to this paper, overall feedback, whatever you want to communicate, you can communicate me. You can communicate with me using this number. So make sure that you, if you have any problem, you can contact me at this number, and I will be very happy to help you. And definitely it will be an honor to help you in relation to whatever problems you are facing. So this is my number. Please, you can note down the number as well. That's how we'll communicate during and after the webinar. Now, the types of students who are appearing in March 26, a quick input I want from you people. Please, those who are appearing for the first time in March 26, please mention it that you are appearing for the first time and your country as well. So I just wanted to have a quick look. The people who are listing me right now, their countries, and those who will respond who are giving paper for the first time. Yes, please, first timers, need your responses in the chat box. Okay, I've started receiving the responses. First timers are from Kenya, India, Zimbabwe, Pakistan, as I can see, South Africa, a lot of different countries here. Please, everyone who is giving for the first time, please do mention here in the chat box. Just mention that it is your first time and your country as well. All right, thank you very much for your input in relation to this question that I asked you people. Now, those who are giving a reattempt, I'm not interested in knowing how many attempts you have given before. Just mention reattempt and your country. So the reattempt students, please mention it is your reattempt if it is, and your country, please. All right. So I can see more first-time students right now in the session. It's a good news actually, because the passing ratio of FM always remains on a higher side. And as I said, passing ratio, you can see it was 46% in September 25, and it moved up by 2 percentage points, going to 48% in December 25. So the passing ratio has gone up. It has improved by 2 percentage points. It's a good thing. Just carry on with the momentum and try to pass in March 26. FM always remains on a higher side compared to other skill papers, especially the one I teach is PM. Now, let's quickly look at certain major reasons for failures, because those who were not part of this passing criteria, those who were not able to pass, so they must know, they should know what are the problems they might have done in the examination, plus those who are getting for the first time, they have to make sure that they don't end up repeating the mistakes their friends have done in the past. So let's have a quick look at the list of certain important reasons why students fail. Some are the general problems that I have experienced in so many years, and some are paper specific issues. First of all, people are not clear about the question requirements. The verbs and the objects are not clear. They're not very clear what the verbs are, what the objects are. If you're still not sure what I mean to say here, this is a very CRQ based problem. That is, people are not clear about the term discuss, briefly assess, justify, explain, things like that. So they are not clear about the CRQ requirements, especially when it comes to the theoretical part, and they end up misreading it and they lose marks. Number two, because you are not clear what the requirement is, obviously you end up in a problem where you are not answering the question according to what is needed. You're not answering it according to the requirement. So because you haven't understood the question properly, it gets difficult for you to actually answer according to that. So it is very, very, very important to understand the question requirement properly. Time management issues obviously remains a big problem. People are not able to complete the paper. They do not do proper rehearsals before the examination, and that is why they end up losing marks. They end up not completing the paper, which is not a good sign, which is not a very good, to be very honest, because you should at least try to complete all 100 marks, because if you don't complete 100 marks, you give yourself uh, simply less chance to pass, because even if you leave 5 marks, even if you leave 7 marks, so you must realize this, that your marking then will be done using 93 marks or 95 marks. So you are giving yourself less chance automatically not to pass. Then this selective study problem is a very genuine problem. I don't know what is the reason people prefer doing selective study, maybe because of lack of time. Initially, they don't cover things. At the end, when they wake up, so they wake up just to realize that the time that they are left with is not enough, and then they have to go with selective study. And the criteria of selective studies sometimes is on the basis of your own likings and dislikings, the topic, the area that you feel you don't like it, you don't want to study, you think that this will not be tested in the examination, you leave it. And then obviously any question comes from that area, you struggle and you lose marks. Lack of practice is another reason for failure, where students know everything, they have covered everything, but because of the lack of practice, they are not clear about the variety of questions that can come in the paper. And because if you're not clear about the variety of the questions, you end up losing marks in the paper. Failing to use brought forward knowledge. Yes, this is also a very common problem that we have seen, that anything that are connected from previous areas, students not tend to recall those things, and they again end up losing marks. So anything that is connected from your previous exam, maybe your MA paper, not very much, but little things, you should have the clarity about those. Now, not good in all areas. So what kind of areas we are talking about? It's the My Exam Performance Report that I'm talking about. My Exam Performance Report, my friends, basically is a very good report that you guys, the students who could not pass, they receive from the examining team, where they highlight lot of areas where students have done the mistake, and gives you a very thorough feedback in relation to what wrong they have done. So basically, they shared one of the feedbacks with you people, where they mention that application, knowledge based, narrative side, and calculative area. So they do tell you where you are lacking, in terms of, like, if you're not good in calculation, they mention it. If the percentage that they will show will be less than 50%, which is again not a good sign. Again, the knowledge base, the conceptual understanding, if it is weak, they'll let you know about it. Then comes the application part, where you are not able to apply the knowledge properly. That is very crucial from exam perspective, so you get a feedback about that as well. And same for narrative parts, where we are struggling in the theoretical areas, so you get a feedback about that as well. Now, any percentage less than 50% will be considered bad, because you are below the borderline in respective area. So you guys have to see, if you haven't passed the paper before, just open your My Exam Performance Report and see in which areas you are below 50, where you must work first, in terms of improvements, and try to improve in those areas. Then Section A OTs are creating problem for students. This may be due to selective study that they do, or they are not clear about the requirement. The questions that are related to OTs or objective test are technical when it comes to FM exam. So yes, Section A OTs, where people needs to bring improvement, especially in certain chapters. I'll just name and highlight the chapters that you should have clarity in relation to those. Number two, people are struggling in MTQs that pertains to business valuation and risk management. Yes, you can expect one question each for business valuation and risk management, because they are not tested in CRQs. So it is very important that you prepare yourself for these areas. And yes, students are not reading the requirement properly in these MTQs as well. They're not understanding the statements, because if there are 3-4 statements given, they must read it thoroughly to understand the meaning of the statement, so that they don't end up selecting the wrong statements or choosing the wrong statements. Mentioned earlier, people are struggling in CRQ theory. I don't know why. The theory at FM level is not very complicated, to be very, very honest. Reason being, things are very much repetitive in nature. I have shared my documents to my regular students regarding the theory drafting. So I've done an analysis of so many exams that have been held for FM, and I've shared those documents with you people, where it is very clearly you can observe that a lot of things are repeated in FM. So you just have to get hold of those basic things, and you'll be able to make it. So this is one word area where people really need to put their efforts. And one of the major things that I see is people are not grabbing the easy numbers. When you fail to grab easy marks, that is where you make yourself into a position that you are not able to pass. Those who are not able to understand the easy numbers, those who are not able to grip the easy numbers, they tend to lose their passing position. Okay, so please make sure that you do take into account easy marks, easy numbers. Yes, there are certain bouncer questions, there are certain in swinging yorkers. I do understand, but but what I personally believe is, you need to ensure that there are easy numbers. See, you are not targeting 100 marks altogether. Yes, you have to solve 100 marks, but in those 100 marks, the target should be of 50 marks only. 50 marks only. So first 50 marks I'm targeting here. There are easy numbers in section A, B, and C. I will try my best to highlight all these in this webinar so that you learn how to grab the easy numbers. Remember, guys, the paper is easy. You need to target 50 marks first. It never says only 50 marks. It says first 50 marks is what you have to grab. I hope this is clear to all of you. These are the major reasons. Just figure it out. If you think one, maybe two, maybe three, maybe several are your issues, try to work. Still, you have lots and lots of days left. All right. The paper structure, everybody has a very good idea about the paper structure of FM. The paper is divided into section A, B, and C. Section A contains of 15 objective test questions, followed by section B, 3 case style questions, and section C is all related to constructive response areas. Important observations you already know. If not, you just note it down. Business valuation and risk management areas will not be tested in CRQ. So there is a very, very high chance that you can expect 2 questions coming in section B from this area because they are not tested in CRQs. Other areas that are important for CRQs, the toppest, the most important is investment appraisal. This is one area that is tested almost every time in CRQ. So you have to prepare. We have done lots and lots of questions relating to investment appraisal in the past webinars as well. So this is a very important area. The other question may either come from WACC or working capital. So there is a very high chance if the other question comes from business finance area, so the other MTQ will come from working capital, or if the CRQ comes from working capital, the other question can come from business finance, including WACC. Okay. So section A, when I say you must be ready, you must be ready for section A, because section A can come from any area, and that is where people are losing the marks. Okay. So please, still you have a lot of days, no selective study allowed to be done. From exam perspective, the time management is very important. So it's a 3-hour exam, and on an average, you are given with 1.8 minutes per mark. So for 1 mark, you have 1.8 minutes, right? On an average, you have 1.8 minutes per 1 mark. So make sure you just keep this in your mind. And as we'll move on, I will discuss a lot of techniques keeping this 1.8 minutes per mark in mind. All right, day-wise plan. Day 1, we will try our best to cover all section C, B, and A areas that I've planned. Same, the sequence will be for day 2, section C, B, and A for all important areas. Yes, I will be targeting the latest questions. I will be targeting the latest questions that examiner has published, and those latest questions that now are available pertains to September and December 25 attempts. So my target will be to solve these latest exam questions with you people in these webinars. It will give a very good opportunity to all of you, those who are appearing for the first time, to get to know the recent exams questions that have been tested. This will give you a good basic quality of the level of question that has been tested. And more importantly, those who were not able to pass, they'll be able to gauge what went wrong, why they were not able to pass, and what mistakes that they have done, so which will help them to improve in the later attempt. After that, because these 2 days are free for you people, after that, you can join the revision batch if you want to. The revision batch has already started, by the way, but those students who will be part of these webinars, they can definitely join my revision batch, which basically is a one that will cover a lot of important things. And this revision batch, basically we have made targeting the self-study students. So all self-based students, they can take maximum out of this revision batch because this revision batch includes, number one, pre-recorded content of 25 to 30 important exam areas. Okay, 25 to 30 important exam areas. Questions are part of this pre-recorded content, including the past papers. So what we have done is we have targeted the important 25 to 30 hot areas for March 26, and the questions that are related to those. So any student if who enroll in this revision batch and only focuses on those areas and those practice questions, they will be in a very good position to ace in March 26. Plus, on top of it, there are two mocks available as well with debriefs. So one mock will be a live mock that we will be conducting in the month of February, followed by a live debrief that I'll conduct where I will solve complete 100 marks in front of you. and that one mock will be marked as well. On top of it, there will be a grand revision session where I'll be revising all the important materials relating to FM in few hours, which will be a very good confidence booster for all of you before the final mock that you'll appear and your final exam as well. So all the interested students who are willing to join this revision camp, I'm again saying self-study students, because those who are already part of my revision batch and reset batch, there's no need for them to join. They already have everything available to them through their portal. The plans have been shared with them, but those who still are doing self-study and need something very solid at the end a few days, so this is the batch for them. You can contact the admission department at this number, and admission department will be more than happy to help you. Okay, now I will be sharing a plan of action for those who will join the revision batch, and the regular students also have to follow the same plan. Once you are part of this revision batch, uh, which already has started maybe 3 to 4 days earlier, so you are given with the recorded content, along with the practice material, uh, plus very important handouts are also part of this portal, which will help you to plan your studies properly. So all these you have to try to complete till 20th of February, because you have your mock starting from 21st, or it is on 21st. So you have to try your best to complete before 20th. I did mention this includes all the important areas, recorded content, and practice questions. I simply will advise those who join the revision batch. See, you cannot target each and everything. I know that's a limitation for you, but you can focus on your weaker areas first. So once you get the access, go to the content and see which areas you feel you're not good at, that you will not good previously, like you were not good in working capital, you were not good in WACC. So just focus on those first so that you can come back to the strengthen areas later on. Plus, it will include very good notes that you can cover, theory drafting documents, and $1 million cheat sheets as well, that will help you for the examination. The 2 days of webinar, we are already having it live today and day after tomorrow. After that, I will suggest you to watch the December webinars that I've conducted earlier, which are available on VIFHE's YouTube channel as well, and also part of the portal, followed by a grand revision to be held on 18th of February, which is a one where we'll be revising all the key things. And then we'll have a final grand mock on 21st of Feb. This will be a live mock, followed by a live debrief that I will conduct after the mock, and and we will then be having complimentary mocks. Okay, you can solve the complimentary mocks, and those complimentary mocks will be given with the recorded debrief as well, followed by the result of the first mock that will be shared to you people as well. So this is the plan of action for the next coming 20-25 days. Your exam is to be held on 6th of March. 6th of March. So make sure that you are well ready before the paper. It's not difficult. You just need to step up a bit for the last for last 20-25 days, and you'll be able to make it, inshallah. All right, guys, this is clear. I hope those who are interested in the revision camp, they can contact this support at this number, the admission department. They'll be happy to provide you the details. Now, let's look at the scope of the webinar. The scope of the webinar remains same, very similar to what it has been previously. Uh, we will be revising some basic materials and we'll moving towards the practice. The focus will be towards practice more, and that will be done on the ACCA CBE platform. Plus, I'll be targeting some latest questions as well. Okay. So, always you need to remember, always I mention this a lot of times, easy, smart paper solving techniques are very useful from exam perspective. Uh, there are easy marks available in section A, section B, C of your paper. Make sure that you should have those eyes, you should have those skills or skill set actually to find out the easy numbers. In section A, easy OTs you have to target first. In section B, easy MTQ you have to target first. And in that MTQ, there are easy OTs that you have to target first. In CRQs, you have to start with a CRQ that is your strength, in which you feel you are more confident. You have to start with that CRQ. Okay. For CRQ, please do watch a very important video available on VIFHE's YouTube channel by the name of examinable verb video. This video is very useful because it will give you clarity in relation to different examinable verbs, like what explain means, discuss means, justify means, assess means, evaluate means, briefly explain means, comment means, calculate means. So these are the important terms that students should know, because we are not very clear about these terms and we end up doing mistakes in the paper and we end up losing the marks. Okay. So do watch this on our YouTube channel to get the clarity about the terms, exactly what they mean. On top of it, there is another video. The name of that video is Smart Paper Solving Technique. This is also available on VIFHE's YouTube channel. Make sure you watch this video as well. This Smart Paper Solving Technique video will make your life very, very easier, as you will be able to understand how to find easy numbers, what should be your passing strategy, what you have to target first to grab 50 minimum marks. Okay. So this is the name, search it. Then you will see another video available on VIFHE's YouTube channel by the name of Read the Marker's Mind video. This video is also very important because in this video I've discussed what mindset your examiner will be following when he or she is marking your CRQs. And once you will watch this video, you will get lot of confidence that if those students who can pass with normal average answers, why can't you pass? So you simply have to just understand what I've explained in the Read the Marker's Mind video. You will get to know this will help a lot in terms of theory drafting for CRQs. Okay, so do watch this video. Lastly, my friends, no question spotting, please. Study Hub, self-study students, self-study students. Study Hub is one resource that you guys can use if you are not enrolling in my batches, or even if you are a self-study student and you will enroll in the revision batch. Still, Study Hub, few chapters will be important for you that you can target, and those who have my notes available, they can target my notes for the same chapters, but make sure you cover those chapters before the examination, which includes financial management, function and environment. You can expect 2 to 3 OTs coming up from this area. Generally, people end up doing wrong. Then, and all this I mentioned from OT perspective, okay? Then OTs that you can expect coming from risk management, business valuation, where people struggle in solving these OTs as well. So make sure you cover this area as well from the perspective of OT, followed by debt and equity finance chapters, where you will see a lot more theory. And you will see a lot more theory again in working capital management, and obviously all of the working capital management chapters does have theory involvement. So from theoretical perspective, these are the important areas that one can keep in their mind in order to improve from theoretical perspective. Either it will help you in CRQ drafting and also will help you in dealing with the theory-based OTs, okay, for Section A and Section B. So I hope this is clear to all of you. Yes, just mark these chapters. The more you read, the better it is, but make sure you cover these two chapters, which are very important for Section A OTs especially. Okay, done. Today's topic includes WACC, which is part of business finance, and then business valuation. Let's start with business finance, area one, which is weighted average cost of capital. This section of business finance basically deals with basically deals with basically deals with from where the business should raise the finance. There are so many options for raising the finance, which includes the option of equity, which includes the option of debt. So debt and equity both are the options available to a company for raising the finance. Uh, but you have to remember that whichever source you opt for, whichever source you are planning to raise the finance, you have to keep this in your mind that the finance, whatever you will opt for, will not be free for you, because if you even go with equity, it has a cost. Even if you go with debt, it has a cost. So because finances are not free, it is very important that we do determine what is the cost of the capital that we took for running the business. Either that capital came from equity side or it came from debt side, but we should know what is the cost of different cost of capital that we are using, and we have to make sure that from whichever source I'm raising the finance and wherever I'm investing those finances, that particular area where I've invested the finance should cover minimum cost pertaining to that finance, which means should cover the minimum cost of capital. Having said that, it is clear that the first source of finance, which is a very popular one, is the equity source, and equity is not free. So you need to learn how to work out cost of equity. There are different methods that you will see will be used for calculating cost of equity. Then the other source of finance is preference shares. So you must learn how to work out cost of preference shares. And the third source of finance is related to debt. So you should know how to work out the cost of debt. Let me tell you one thing before we move on to the next slide. The perspective that we are using in WACC is of a company. Company here means someone who is raising the finance. Okay, someone who is raising the finance. So a company, when they will raise the finance, they will incur the cost. So when it comes to WACC, it is always the cost side that we are covering, because it is the company's perspective and it is the company that is getting the finance and paying the cost. Now, for cost of equity, there are two methods that are useful for calculating KE. One is known as dividend valuation model. The other is known as CAPM, capital asset pricing model. If I compare these two, because I've seen a lot of questions coming in the paper where they ask you which method is better. Is it CAPM or DVM? So the answer is DVM. No, just joking. The answer is CAPM, because CAPM provides you market-based risk and return. So when I say market-based risk and return, what it means that CAPM is more practical. CAPM is more relevant because it considers the market-based uh, risk and return relationship compared to DVM. But let's first recap what DVM has to offer. So if I'm calculating the cost of equity using dividend valuation model, which uses dividend as a basis for the calculation, So there are two methods that you have to recall. One is constant dividend method. Second is fixed growth in the dividend. Okay, fixed growth in the dividend means it assumes that dividend will grow by a fixed amount, fixed percentage, and you can work out the cost of equity in relation to that. So the formulas are pretty much clear. You must have these formulas in your mind, and you can work out cost of equity. The more common of these two is fixed growth in dividend, that is tested in the examination. And when I say growth in dividend, so you need to work out the growth rate. This growth rate either you can work out using past dividend pattern or earning retention model. Whatever the information in the exam is, you have to use that information and work out the growth rate and work out cost of equity. Now, as I said earlier, CAPM is much better compared to DVM. The reason why I mentioned is because it covers the relationship between risk and return. Risk and return relationship is covered by CAPM. Now, what I mean to say by risk and return relationship, risk and return relationship here means that it considers market-based risk and return. So there is a very simple rule. The more the risk you take, the more the return you expect, right? So when I say risk, there are two types of risk that it will deal with. Number one, time value of money, and second is additional risk return. Okay, when I say time value of money, what it means, a simple return expected by the investor, because if they've invested their funds for 1 year, 2 year, so as you all know, money loses its value with time, so they need to be compensated. They need to be compensated for the return, for the risk that they have taken, and that is time value of money return that they get. Number two is additional risk return. What is additional risk return? Uh, the risk that they take in form of business risk and the financial risk. So when I say business risk, what I mean? In case of business risk, I mean uh, the risk that pertains because the nature of the business. Okay, so that is the business risk that you take that pertains to the nature of the business, right? And then comes the financial risk, which means the risk of debt. The company, if it is a highly debt company or a company that is taking debt, so investors will face this risk, and this is known as the debt based risk. So this is the return the investor will expect. So CAPM provides you both the risk of time value of money and the additional risk in form of business and financial risk. Okay, the formula is very simple. RF is risk free return. RM minus RF is known as equity risk premium, and beta. Beta is a measure of risk actually. So it is a very simple rule to remember. If beta is greater than 1, so this means the company is more risky than the stock market. And if the beta is less than 1, it means the company is less risky than the stock market. And if the beta is exactly 1, so it is a company that has a same risk as the stock market risk. Okay, as the stock market risk. Done. So done with the revision of this area. Now the other sources of finance that we are looking at. The first source of finance uh, after equity is preference shares. So how to work out the preference shares cost? A very simple formula you guys need to remember. The cost of preference shares will be worked out by using a formula of D divided by uh, P naught, where D is the dividend and P naught is the share price that you will take. Then the cost of debt. So there are different types that you have to cover. Number one is bank loan. It is a non-tradable source of finance. Because it is not tradable, so there will be no market value in terms of debt. And the formula of that is very simple. That is interest 1 minus tax rate. Then you have tradable, like you have irredeemable debt, you have redeemable debt, you have a convertible debt. So irredeemable debt, obviously it's a market based instrument, so it will have a market value. Redeemable debt will have a market value. convertible debt will have a market value. All the three are tradable. So let's see how to work out the cost of debt for them. So remember, for irredeemable, for redeemable, the formula is IRR. IRR that you will use. But sorry, for convertible and redeemable, you have a method of IRR. But the only difference in case of convertible is that you will be selecting higher of value in the last year between redemption and conversion. For irredeemable debt, what is the way to calculate the cost of debt? Again, here the formula is available to you. This is the formula that you have to follow and you will be able to work out it. Now, the more important thing that I want to highlight again is, remember, in VAC, you are a company, and being a company, whatever interest you will bear, whatever interest you will pay will be a cost to the company. I repeat, will be a cost to the company. I repeat, will be a cost to the company. This means you will take the benefit of tax saving, because interest is your expense. Because interest is your expense, you will get tax saving on that interest. So remember, KD is always after tax, after tax saving of interest. Okay, so it's always KD after tax, which means the company will bear the cost of interest after the tax saving. That is the net cost to the company. So in VAC, it's always KD, because it's the company's perspective, because it is the company who is paying the tax. Interest, and they will get the tax saving. So this is all about these different sources of debt finances. Now, WACC, how we calculate WACC. So the calculation of WACC includes the cost of capital for each source that we work out first. Then we have to determine the weights. Now, what are weights? Either market value or book value is what we use. Market value are more better in terms of book value, because market value represents the current operating cost of finance, whereas book value is historical and will not be very much worth it. Okay, so you multiply the cost with the market values, and then you get once you add up all, you get weighted average cost of capital. Okay, so WACC is a minimum cost of capital. WACC is an average minimum cost of capital which company needs to ensure the company will cover, and whatever funds that they have taken from the investors, it is important for them to ensure that they cover this minimum weighted average cost of capital. Okay, so I have mentioned everyone, you work out cost of each source of capital, KE, KP and KD. Number two, you work out the weights either using market values or book values. Once you have the weights, you multiply that with the cost, and then you add up all, you get weighted average cost of capital. Done? Now, once we have learned how to work out cost of capital, once it is clear how to work out cost of capital, what is next? What is next? Remember, the WACC is a cost representation for a company. The lower the WACC, the lower the cost. The lower the cost, the lower the cost, the lower the cost, the more saving company will have. The more the saving, the more will be the market value of the company. So WACC has an inverse relationship with market value of the company. The lower the cost, the better for the company in terms of increase in the market value. The higher the WACC, the lower the market value. So it's an inverse relationship that you have to remember. Okay, inverse relationship. Now, there are certain theories known as capital structure theories that will discuss the relationship between capital structure, which means your debt and equity proportions, capital debt equity proportions with with WACC and market value. Okay, with market value. So what basically is important to remember? What basically is important to remember? So what I'm trying to say is there are different views, different theories that deals with it. The first is a traditional theory. Now what does traditional theory say? Traditional theory says that there is a point of minimum WACC. There is a point of minimum WACC. But what it says at a lower level of gearing. I repeat, at a lower level of gearing, the debt is more attractive to the company. The debt is more attractive to the company because at lower level of gearing, the company can go with more debt. The more the debt company goes with, it gets the tax saving benefit, okay, at that level. And once it gets the tax saving benefit at that level, what happens? The company can increase its debt and the WACC gets lower and lower and lower because the benefit of debt is more than the increase in cost of equity. But as you keep on increasing the debt, so then what happens? The benefit of debt you are still getting, but there is a very high increase in cost of equity, and high increase in cost of equity means that the benefit of debt gets lower compared to the increase in cost of equity, and that is where the WACC starts to increase. The WACC starts to increase, and the U-turn is there. Okay, the U-turn. If you remember the graph, there is a U-turn. It is reducing, and then it starts to go up. At a very high level of gearing, bank also becomes concerned, and they also increase their cost of debt, and further it shoots up the WACC, and the WACC starts to rise, and market value start going down. So according to traditional theory, the point where the U-turn is, the point where U-turn is, that is where the minimum WACC will be a one that company can maintain. So at lower level of gearing, I already told you, as gearing rises, the KE will starts increasing more than the benefit of debt. At a very high level of gearing, I've already mentioned that KD will also rise. So the optimum point of WACC is where WACC is lowest and market value is highest. Then comes M&M no tax theory, which says that there is no taxation, which says that WACC remains constant irrespective of whatever capital structure you have. You keep 20% debt, you keep 90% debt, WACC will remain unchanged, because according to this theory, as you keep on increasing the debt, the benefit of the debt will exactly offset against the increase in cost of equity. So it has a linear relationship. As you get benefit of debt by 2, so the cost of equity will increase by 2 and your net impact will remain 0, unchanged. So according to this theory, it's a perfect capital market, and according to theory, whatever debt structure you keep, WACC will not change, and hence market value will not change. Then comes M&M 1963 with tax world, which says that no, there is tax as well. There is tax as well. And because there is tax, so according to this theory now, because there is tax, so the benefit of debt now will increase and will always be more than the increase in cost of equity, because we have added one more component into the debt benefit, and that is that the impact of tax saving on this interest, that always will ensure that benefit of debt remains higher than the increase in cost of equity. So as you keep on increasing the debt, the benefit you are getting more and more, and your WACC is getting lower and lower and lower and lower and lower. And it says uh, the maximum debt that you can keep, or the optimum point for you, will be 99.99% gearing level, which means at this point your WACC will be lowest and market value will be highest. But the market imperfections do exist. Remember, uh, market imperfections do exist, which means it is not easy for you to go at such a high level of gearing, because high financial risk will be there. There will be financial distress costs. There will be tax exhaustion as well. There will be covenants placed by the bank. You cannot go to such a high level of gearing. Plus, if there'll be a tax exhaustion case, which means you won't have sufficient profits to cover the tax payments, so there'll be no tax savings as well. It will take you towards bankruptcy risk as well. So it's not easy according to market imperfections. Then comes the last theory known as packing order theory. According to this theory, there is no optimum capital structure. It will ask you to follow a sequence, that is, first start with retained earnings, then go with debt, because debt is usually cheaper source of finance than equity, and as a last resort, use equity finance, because equity has a higher cost, and being a higher cost should be used at the last as a source of finance. So it never recommended any optimal capital structure, but it says there is no optimal capital structure. The sequence is important, the sequence will matter, and according to this, what sequence you have to keep in your mind, and that is clearly mentioned. First go with retained earnings, and then debt, and then equity. So I think this is clear to all of you, and it was a good revision for all of you guys. Yes or no, guys? Were you able to recall some important stuff relating to WACC? Yes? Was the revision good enough, everyone? All right. Now it's time for the past paper, Section C, CRQ, certain tips I want to share with you people. First of all, find verbs and objects. We will do the rehearsal of that right now. Look for extra requirements. What do you mean by extra requirements? There will be a word and in the requirement, which will give you the clarity that something else is also required to be solved. So in one question, there might be more than one verbs, more than one objects. Do consider the marks, because extra requirements means the marks are allotted accordingly. You have to grab complete marks, and to grab complete marks, you have to fulfill all the requirements. For theory drafting, use headings. Multiple paragraphs with headings would be nice. Generally, when I say headings, so I can connect these headings with the objects that have been tested in the question. 2 objects, 2 simple headings, 3 objects, 3 simple headings. At least the reader will get to know that what all I've asked from the student, they have tried to answer that. Okay. Remember, spreadsheet is a source of competitive advantage in this paper. A lot of things you can do quickly using spreadsheet. A smart user spreadsheet will save ample amount of time. I always say in questions of NPV, if there are 4 years, 5 years that you have to work out the cash flows and you have to work out NPV, a smart working if you do for year 1 using proper formulas and all, you can copy paste that in year 2, 3 and 4. Automatically you get the figures. And I've done a lot in my previous webinars as well, in my classes as well. You go and check December 25 webinar, you will see questions. You go beyond, before that, you will see further questions. Lot of questions where I've discussed a lot about how to handle the CRQs on spreadsheets, especially for investment appraisal, where you can save a lot of time. Remember, you have 36 minutes to complete one CRQ. So what I always recommend is start with the easy CRQ first. A CRQ in which you are more confident. A CRQ in which you feel that you can really do good, that matches your strength. And whenever you start with the CRQ that matches your strength, what you end up doing is you end up completing that before time. It saves time for you. Like if it is a 36-minute question, you might do in 30 minutes, might 31 minutes, 32 minutes. So even if you save 3 minutes or 4 minutes, it's a blessing, to be honest, that you can spend on some other difficult area. Remember, 2 CRQs, weightage is of 40 marks. You need 20 minimum to pass. 20 minimum to pass. So the target is simple. You are allowed to do mistakes. You just need 20. On an average, 2 CRQs means 20 marks theory, 20 marks calculation. So your strength is calculation. Try to first grip the calculative area, grab maximum marks, so that even if you write bad theory, you will gain something to reach to at least 50% in CRQs. And I always say 50% in CRQs, 50% in Section B, 50% in Section A will ensure you get 50 out of 100 for sure. And if you get 50, it's like 100, because if you get 49, it's like 0. So let's target the easy numbers first. Done. I hope this is all clear to all of you. Now it's time to start with the first question available on ACCA CBE platform. We will start with this latest exam question. I hope, guys, so far things are going good. We had a good quick revision. So I hope this revision will help you and you can further take benefit of this revision while we are solving the questions as well. Okay. All right. So here we are starting with our first question. Our question for WACC, in fact, a CRQ. A simple rule of thumb. First, read the requirements, mark verbs and objects. Calculate the market value WACC of mean co. Examinable verb is calculate. The object is market value WACC for 10 marks. This is the object. Okay. Requirement 2. Critically discuss. The examinable verb is critically discuss, which means you need to be critical in your discussion. You need to highlight the problems, the negatives, if there are any, because word critical means you have to highlight the issues. So critically discuss the relationship between capital structure and WACC. Okay. Referring where necessary to relevant theories and concept clearly means that you have to use capital structure theories for 10 marks. So the object is relationship between capital structure and WACC. The verb is critically discuss. The verbs will tell you the direction of the answer. The verbs will give you clarity what action to be performed, because verbs exactly means what? Action. Okay, so what action to perform. This is for 10 marks. Done with the 2 requirements. Now I will read the scenario and will solve one by one. Every WACC question will have a balance sheet extract. If you remember the $1 million point, so you have to highlight how many sources of finance the company is using. The question says the following information relates to MeanCo. You can see their ordinary shares, equity is their first source of finance, which is 15 million, reserves 45 million. Then you have 7% loan notes. This is your debt, 10 million. You have a bank loan of 5 million. Now, what is the difference between loan notes and a bank loan? The difference is bank loan is non-tradable, will not have a market value, whereas loan notes will have a market value. The ordinary shares have a nominal value of 0.5. I always recommend students, while reading the question, please highlight all sort of numbers percentages. So the ordinary share have a nominal value of 0.5 per share, current market price of 7.26 per share. A dividend growth of a dividend of 0.49 per share has just been paid. It is very important from WACC perspective, had this been paid or not. And future growth rate of 5% is expected. So the growth rate is given. Thank you very much. The market price is 7%. The market price of 7% loan notes is 94.59 per loan note, and interest has just been paid, which is again important for this question. The loan notes are redeemable in 7 years' time at their nominal value of 100 per loan note. So you can see I'm highlighting all numbers, percentages, and even anything which is not written numerically, but it is a number like 7, alphabetically written, I have highlighted that as well. Variable interest rate is paid on the bank loan, and the average interest paid over last year has been 8.5%. The company pays corporation tax 20%. Done. Let's calculate the WACC, and that too market value WACC. Okay. So let's make it a more visible case for you. Now, I will start with the calculation of WACC, and the steps of WACC should be in my mind. First, I'll work out the cost. Step 1 is cost of each source, cost of equity, cost of KD, cost of debt, loan notes, cost of debt, bank loan. Okay. Now for equity, the $1 million points, if you remember, those who know my style of teaching, I've already made it clear that you have to see in the question, you have to figure out or realize by looking at the question that what kind of information is given to you. So you can see here the information that is available to us to calculate KE is CA, PM or DVM, because dividend information is given. So it's DVM that I'll be following here. DVM method includes D1 divided by P0 plus the growth rate. Okay. So let's do it. The dividend that has been paid is 0.49. Okay. I will grow this by 5%. We'll grow this by 5%. 5% will be the growth rate. Okay. Divided by P0 is the share price 7.26, because dividend has been paid. And whenever you paid the dividend, so the share price is X dividend. We always take here X dividend share price. Okay. Then after this, we will add up the growth rate here. So which is 0.05, and you can see the calculation. The current dividend paid is 0.49. We have increased it by the growth rate of 5%. We'll divide this with P0. We'll plus the entire answer with the growth rate, and the answer that we will get here is 0.1209. I will convert this into percentage and might keep this to one decimal place. So it's 12.1% as my KE using DVM. I am very sure that everybody has clearly understood this calculation done in one cell. Okay. All right. Now the KD. So for KD, I will be using certain working area. Uh, you can make a working area like W1, and here I have a working area representing W1. Okay. So how will I work out? So IRR is what I'll be using here, and the loan note is a redeemable loan note. It's not a convertible, it's a redeemable loan note, and for redeemable we always use IRR. So I can use my shortcut. If you guys know the shortcut that I have covered, we have discussed a lot about this shortcut as well. We need to show certain cash flows. So it's the market value that we will be showing here in terms of negative value. Then interest is what I'll be showing here. Okay. Uh, now, the market value is given to me negative 94.59. Okay. Interest I will be showing for all the years. So this will be redeemed in 7 years' time. So I'll be showing interest for how many years? 7 years. This is year 0, year 1, 2, 3, 4, 5, and 6. I'll copy this. We'll paste here. Interest for 6 years, even though it's 7, I will show the last year interest as well. So coupon rate is 7%, guys. 7%, because it's WACC that we are calculating. The company's perspective I have to take. So coupon rate is 7%, which means I'll multiply this with the nominal value of 100. I will get 7 as my interest per year, but I have to make this after tax. After tax, okay? So this calculation will look like very simple. 0.07 into nominal value of 100 into 1 minus tax rate. Okay, this is 20%. So you can see the calcs here. 7% of the nominal value into 1 minus tax, because it's a WACC question, and in WACC we always takes after tax, because tax is an allowable expense. And I've already mentioned that in WACC it's the company's perspective that we use. So it's 5.6 for all the years. It's 5.6. I'll copy this, let's paste here, 5.6. Now the last year, redemption amount plus interest. Okay, plus interest both. So 5.6 plus the redemption amount. This will be redeemed at its nominal value. So I'll just take 100 here. That's it. So you can see 5.6 plus 100, 105.6 in the 7th year. Done. Now, the magical IRR formula, IRR, let's select. Done. Clear, everyone? Very simple. You guys know I can perform this calculation on CB platform using the IRR function that I've done here. Market value in year 0 shown negatively, then interest and the redemption amount at the end. Let's add them all together. So the answer, if I just work out in terms of 1 decimal place, in percentage will be 6.6%. Clear, everyone? Good, crispy time saving. So I hope no problem. I will give the reference of this calculation here. Now, bank loan, because bank loan is not a tradable instrument, so the coupon rate of bank loan is 8.5% that I'll be using straight away without any problem. 0.085 into 1 minus tax rate. So this is the quickest way to make anything which is before tax to after tax. Because this 8.5% is before tax, we need to make this after tax, and the quickest way is to multiply with 1 minus tax rate. I hope this is clear. It's not a tradable one, so we won't trade it. There will be no market value for this one. And the cost of debt that we have worked out is 6.8. Now, KE calculation done, KD of a bank, KD of loan notes done, and bank loan done. I hope this is clear. Guys, if you have any question, please wake up, and let me know. Okay? I hope this is clear to all of you. The first part of cost of each source of finance has been done. Now, step number 2 is the market value that we need to work out for equity, for loan notes, for bank loan. Okay? So we need to work out the market value. Now, all right. So, equity market value depends on the share price. So the share price is already given to you in the question, that is 7.26. But the important thing is the nominal value is 0.5 and the ordinary share capital is 15 million. So what exactly you are required to do here is equals to 15 divided by 0.5 into 7.26. Number of shares into share price. Number of shares into share price. So 15 is the ordinary share capital. I'll divide this with 0.5 and multiply with the share price. So I'll get the answer of 700 and 217.8 as my market value of equity. For loan notes, the book value of the loan notes is given to you. It's 10 million. The nominal value is 100. This divided by 100 into the market value of the loan note is 94.59. So 10 book value divided by nominal value of 100 per loan note, and this is the value. For a bank loan, there is no market value. So whatever is the book value will be your market value because it is not a tradable one. So bank loan remains at 5 million. Okay. And here I have the capital employed. Here I have the capital employed, market value of capital employed. I'll just add them all together. All right, done everyone? Clear? Okay, now step number 3. Step 3, we'll multiply cost with the market value. So you can see the formula of multiplication. Okay, formula of multiplication. I will copy this, will paste here, Control C, Control V, or you can use the right click button on your mouse as well to copy and paste. Done. Okay, then let's sum and here you have the WACC, this divided by this. Okay? Are we clear, everyone? Yes or no? So the answer of WACC is 11.7. So let me just give you a quick recap. I worked out cost of equity. 15 is my ordinary share capital given in the balance sheet. The nominal value per share is 0.5. I'll divide this to get number of shares. I'll multiply this with the share price currently, that is 7.26. Then loan notes, book value 10 million divided by nominal value per loan note of 100 into the market value per loan note. Okay, bank loan, same as book value because it doesn't have any market value. You will multiply them with their cost, will add up and divide this to work out WACC. All right, everyone, are we clear? Yes or no? Done? Okay, right. I think your question is wrong. You want to ask for KE, not KD, first of all. And why didn't I took, sorry, why I took 7.26 is because it's ex dividend share price. When dividend is already paid, whenever the company pays the dividend, so the share price is called as ex dividend share price. Okay. So we don't have to remove the impact of dividend from it because already the share price excludes the impact of dividend that has been paid. So that's why we took 7.26, which already is a price which excludes the impact of share price. Got it? Okay. Payment clear. Done. So I hope this is clear to all of you guys. Yes. Done. Dusted. Clear. Everyone. Feedbacks, guys, so far. How the session is going. Feedbacks. Through emojis. Okay, I think we are done with this one. Now it's time to move towards the next part. And the next part is a 10 marks straight theory. 10 marks straight theory. Okay. Now, the next part is critically discuss relationship between capital structure and WACC. What is the term capital structure? Capital structure means the ratio of debt and equity. Okay. The ratio of debt and equity. The ratio of debt and equity. How much will be debt? How much will be equity? This is known as capital structure. Okay. So if you keep more equity, if you keep more debt, what impact will that have on WACC and hence the market value of the business as well? So it's a 10 mark requirement. How can I plan? Always look at the verbs. I have seen here one verb, one object. Okay. Then always decide the question is application based or knowledge based. Now, what is knowledge based? Simple bookish theory is what you have to write. Knowledge based means all conceptual understanding that you have gained through the books, materials, videos that you have to write. In application based, it is one step ahead. All that you know, you have to apply to the scenario. It will be scenario specific answer. And how to differentiate whether it is knowledge based or application based is by reading the requirement. The requirement itself makes it very clear. Like if you see here, critically discuss relationship between capital structure and WACC, and nothing is written about the company here, like in relation to M company, referring your answer to M company. So there is no hint as such given to connect with the scenario. And when it is not given here, so this is a knowledge based requirement and not an application based one. Application based requires connection with the scenario to get the marks. But in knowledge base, it's not a problem. You have to just properly write according to the requirement without applying that to the scenario. So it's a good thing. This question is a knowledge-based requirement. Okay? Knowledge-based requirement with verb being critically discussed. Just for your planning purpose, I'm writing here. This is not required in the paper that you do this work. This is right now I'm just doing to give you the clarity. How do we break it into small components so that we do not deviate and write what is required, because your answer should always be according to the object. Okay. So which type of question this is? This is a knowledge based question. Done. These three things that you have to look at the planning phase before you start writing it. This is a very good way to plan the answer, especially theoretical one. To look at the verbs, the objects, deciding it is knowledge based or application based, and headings if you can plan. Okay, headings if you can plan. Headings. So I can plan the headings here by mentioning following are the theories that discuss the relationship between capital structure and WACC. Now I know the theories here. I know the names of the theories here, right? Okay. And these will be my headings. Traditional theory, M&M, no M&M theory. Under this I'll write both packing order theory. So what is the key takeaway for now is whenever you are planning to write a narrative CRQ, so remember certain important tips. Find verbs, objects, look at the marks, okay? Then decide it is knowledge based or application based, and the headings if you can plan, right? So in M&M there will be no tax and with tax both, right? And with tax both. So it will include both. So technically there are four things: traditional theory, M&M no tax, M&M with tax, and pecking order theory. So what I'll do, I'll split this 10 marks into four things. 10 divided by 4, just to get a rough idea. Like for each and every area, I need to write for 2.5 to 3 marks. 2.5 to 3 marks for traditional theory, for M&M no tax, with tax, pecking order, khalas. Okay. So certain tips, I've made it very clear. Verbs, look at the verbs, look at the objects, figure out, is it knowledge based or application based? Number 3, find out the headings if you can plan, and look at the marks and split accordingly. Split accordingly. If there are 4 areas that I'll be covering, so approximately 2.5 to 3 marks each. Understood the tips, guys? Yes or no? Great. Now it's now time to take a break. Let's take a short break, and after the break, I will answer according to the structure that I've planned. Whenever you attempt any narrative, a short, quick planning, maybe for a minute or 30 seconds, will help you to write according to the requirement in the proper manner. Now, following other theories, uh, 4 theories are mentioned here. Let's begin. Starting from traditional theory, you have to write in form of paragraphs, maybe multiple paragraphs under this heading. That can work. Okay. So, according to traditional theory, you remember the basic points that you have to write in form of paragraphs. Okay. At a low level of gearing, the company will be inclined to use debt as a source of finance because debt is cheaper finance option than equity. So any increase in debt will mean that benefit of debt will be more than increase in cost of equity, and hence WACC will reduce. At this level, shareholders are not very much concerned about increase in debt due to low gearing level. Done, guys? Clear? Okay. I can change the paragraph if I want to. It's good to write in small multiple paragraphs. As debt keeps on increasing, so shareholders then will be concerned and will result in more increase in cost of equity due to higher financial risk because of debt. So, at a level, so there will be a level where KE will, where the cost of equity increase will be more than cost of debt benefit, and WACC will start to rise. At a very high level of gearing due to bank corruption risk, the bank may even increase KD, thus resulting in further WACC increase. Okay, guys? So, the optimum level of gearing will be where WACC is lowest and market value will be highest. Done. So this is what traditional theory has to offer. All right, everyone? So we have discussed the relationship between we have discussed the relationship between the capital structure and WACC as per traditional theory. According to traditional theory, there is an optimum level of WACC. Done. Now, M&M. According to M&M no tax theory, and assuming perfect capital market, the WACC will have no impact due to any capital structure and hence market value will remain unchanged. This is because the benefit of debt being lower risk will always offset against the increase in cost of equity. So no matter what is the capital structure any change in debt to equity proportions, any change in debt to equity proportions, the impact will be zero. However, impact will be zero. Is that clear, everyone? So, according to this, there is no optimum point where I can say this is the optimum point for capital structure. Is that right, everyone? Yes or no? I hope no problems as far as this is concerned. Okay? Clear? Done? Now, moving forward, the next one. M&M, then considering tax as relevant, came up with a change in above theory by mentioning that due to tax saving on interest, the benefit of debt will always be higher than the increase in cost of equity at any level of gearing. This means company will be inclined to increase debt, and the benefit of debt always being superior to increase in cost of equity will keep on reducing the WACC. Okay, hence the theory says 99.99% will be the optimum level of gearing where WACC will be lowest and market value will be highest. Done. Everyone. But another paragraph, however, market imperfections, suggest that this practically was not possible as there are factors to consider like bank corruption, risk due to high financial risk, comma, covenants placed by banks themselves and tax exhaustion, meaning profits won't be sufficient enough to cover interest cost, and hence benefit of tax saving will not be available. Okay? Clear, everyone? Done? So this was all about M&M no tax, with tax. All what I've written is not out of the box. This is all knowledge-based stuff. The pointers that I've taught my students to remember, and I'm just, using the paragraphs to write all this knowledge-based stuff. Right, everyone? Then comes packing order. According to this theory, there is no optimum capital structure. Okay? The company needs to follow a sequence when raising finance. First, the retained profits should be used, okay, followed by debt as a source of finance, debt being cheaper than equity, and in last, equity should be used as a finance option. Clear, everyone? Okay? Done? Conclusion. All these theories have different messages. Now, how can I conclude what companies should do? You can't use M&M with tax theory and kill yourself. M&M no tax is perfect market theory. So again, will not exist in practical world. So what is the best way out in real world? Yes, debt is a cheaper source of finance. So the company should take the benefit of maximum debt being a cheaper source of finance, but till the extent where the cost of equity should not go too much up, or the financial risk should not increase. So it is a situation of creating a balance between cost and benefit. Okay? So in real world, the approach should be to use debt as a cheaper source until its benefit is more than increase in cost of equity and the financial risk is not too high. Okay? In order to benefit from lower WACC. That should be the wise technique. Sensible. Take debt till a level that your WACC is lower. But when you feel like the benefit now will be over, the benefit would be outweighed by the cost, the risk, and it is giving company hard time in terms of bankruptcy and all, making company a highly financial risk company, then you should not opt for debt anymore. You need to switch to equity. Okay? So you need to keep debt at a reasonable level. And then use equity. So debt should be used at a reasonable level, and after that equity can be the option. Okay? Now, done. A quick one before I conclude. Traditional theory, everybody knows at a low level of gearing, the benefit of the debt is more than increase in cost of equity. So you keep on increasing the debt, you take the benefit, your WACC goes down, 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 down. Then comes a point where shareholders are more concerned and they start increasing the cost of equity more. The K goes up sharply because of a higher financial risk, and the U-turn comes into the WACC and WACC goes up. So the minimum point of WACC is, capital structure is when WACC is lowest. M&M no tax says WACC will remain unchanged irrespective of whatever capital structure you have. Even if you increase the debt, the benefit of debt will be offset against the increase in cost of equity. So it is indifferent whatever you keep. So WACC remains constant, market value remains constant. M&M with tax says no, because WACC also is subject to tax saving. Sorry, debt is subject to tax saving. So the benefit of debt now increases because of one additional top up into it, and that is the tax saving impact. Because of this top up, the benefit of debt now always supersede the increase in cost of equity. As you keep on increasing the debt, the benefit will reduce your WACC despite increase in KE. So you can increase till 99.99% your debt. But market imperfection says that's not practically possible because there is a bankruptcy risk in the practical world. Tax exhaustion will be there. Your covenants will not allow you to do it. Whereas packing order says no structure, no optimal structure, follow the sequence. Clear? Everyone? Understood? Yes or no? Come on. So this is how I've drafted in front of you. You have seen the verb was critically discussed. The problems I've mentioned, market imperfections, is a clear criticism done on M&M with tax. This was the object. It was a knowledge-based requirement. These were the headings and the marks were 10. Done? Love it, everyone. The way to write theoretical parts. Say yes or no. Done. However, in your final answer, obviously, this is not required. This is just for planning purpose, okay? So you may remove it in the exam. Done. All right then. Business valuation is opposite to WACC. I always say, the way I teach people, I say business valuation is opposite to WACC. What this means? In WACC, the focus was on cost. And cost means company. Because company is taking the finances, and in return, company needs to pay the cost like equity cost, preference share, and debt cost. So in WACC, the perspective we used to take was of company. But now in business valuation, the perspective that we will be considering is of investor. Investor is a person who is providing the finance. To whom? To the company. So in WACC, we had a different perspective. We were using the perspective of a company, someone who is taking the finance and using the finance, and they are bearing the cost of that. In business valuation, the perspective is of investor who is providing you the finance. Let it be equity investor giving you equity, debt giving you debt, banks, and preference share holder. So because the perspective has changed now, so the thought process should change. In business valuation, you will be required to work out the value of equity, preference shares, and debt. Whereas in WACC, you are calculating the cost of equity, the cost of preference shares, and the cost of debt. So there, these three things were available, but from the cost perspective. Cost perspective. Now, all these three are again here, but from the value perspective. So in WACC, Share price was given to you, you were calculating cost. Share price was given to you, you were calculating cost of preference shares. Market value was given to you and you were calculating cost of debt. So the values like share price, preference share price, market values of debt were given to you and you were calculating cost using that. Here it's the opposite way around. Here cost of equity will be given to you, cost of preference shares will be given to you, cost of debt will be given to you. Okay, but what will you will be calculating here? Share price and market value. This is the most easiest summary ever. So the perspective has changed and the mindset will be of investor. Now, understood? You will work out share price, KE will be available to you. You will work out preference shares, price, KP will be given to you. You will work out the market value, KD will be given to you. And here you need to understand one thing. In debt, when you are at WACC, the perspective you took was a company perspective. And for company, paying interest results in tax saving. So the KD that you worked out was after tax, incorporating the tax saving benefit. Because for company, if they pay $100 interest and if the tax rate is 20%, they get $20 tax saving. And because of that, their cost from 100 comes down to 80 because of tax saving benefit. Their cost goes down. So who is benefiting from the tax relief? Company. So that is why KD always used to be a working where you were netting off the tax benefit. This was always after tax. As I said, 100 is the cost of interest, 20 is the tax benefit, 80 is the net cost for the company. In business valuation, that will not be the case. In business valuation, it's the investor perspective. And here, any interest paid by the company, means for investor, it will be 100 only. Now, if the company is paying 100 to the investor, so what investor receiving? 100. Tax saving is the benefit that company is getting from the tax authorities. So for them, this is a tax saving. But what investor received? 100. Company paid 100, investor received 100. So because investor received 100, so in case of business valuation, we always take KD before tax. Because in business valuation, we are not taking the impact of tax saving on interest that is being given to the company and not the investor. Investor receives 100 return. It's a return for the investor. So this KD is actually a return for the investor. So I can say this like KD before tax is a return of investor. So remember, in business valuation, we are not considering the tax impact on debt because that is not the company's perspective. The perspective is of investor. So we are always considering KD before tax. The return of investor will be before tax and not after tax, because it's the return that the investor is getting. And a very simple example, if you are a company, you paid 100 interest to the bank. So what bank received is 100. It's before tax. So that is one confusion people do. And I always say in business valuation, the perspective now has changed. Now you are calculating share prices and market values. So the cost side will be given to you first of all. So any question where cost is given and they ask you to work out prices, so it's business valuation that should simply come to your mind. Number two, in case of debt, always before tax you have to take, because investor is getting a complete return. Khalas. Done. So whenever you see a question of business valuation, what is important to keep in your mind? Tell me. Cost will be given to you. And in case of debt, this will be before tax cost. Khalas. Okay. Now, the methods to calculate share price includes discounted cash flow method. This is very much simple, similar to NPV, where you work out the present value of future cash flows. The cash flows of a company are given to you, you discount it, and you calculate those present value that results in a share price. One method. Second method is similar to what we covered in VAC. In VAC, it was dividend valuation model. Here again, it's dividend valuation model. But now, formulas and everything will change. Method is same. With constant dividend and growth in dividend. But the difference now is we will rearrange the formula for share prices now. Share prices. Because KE, as I told you, will be given now. KE will be given. So share prices rearrangement will be done only here. Halas. Done? Clear? Okay. The limitations of this DVM model is the estimation of growth rate, the estimation of KE that you are taking in the calculation of share price might not be same as per market expectation. What shareholders are expecting might not be same, resulting in a different share price compared to the share price that is in the market. Plus, not applicable for companies that are not paying dividends. So any company who is not paying dividend in the future, you cannot calculate the share price for them. Done. The other method is asset-based valuation, which basically emphasis on calculating the net assets, which is all asset minus all liabilities. So method 1 is book value of net asset. Method 2 is NRV of net asset. Method 3 is replacement cost of net assets. Out of all the three, the best is, come on, you tell me, NRV. Because book value is very old, historical, too less. Replacement cost is a one that says what it would cost to buy a similar new asset. So again, maybe high. Okay. The best is NRV. That is net realizable value. What will we realize from these assets today if we sell them, if we liquidate the business? Okay. So asset-based valuation will highlight you the value of assets, which is useful as it will give you a minimum valuation of a business, Okay. But it has problems like it ignores intangibles because it is simply tangible based. Intangibles like goodwill, brand image, all will be ignored here, right? Plus, the assets that you are thinking has this amount of NRV, the net realizable value, the resale value in the market. But the question is, do they have that earning potential? Are they capable enough of earning good cash flow in the future? So we are not considering their cash generating ability. Okay, so that's the problem. Third group is earning based valuation, through which you work out the share price using methods like PE ratio method, earning yield method. So it's a very simple formula: PE ratio into EPS, earning yield method like EPS divided by earning yield. The only problem you have to remember for these methods is the proxy determination might be difficult. Proxy PE ratio, proxy earning yield. Now what proxy is? Proxy means finding a suitable proxy means similar company or the industry average. If you are trying to buy any company, so the proxy will be the competitor of that company that you want to buy or its industry average. So finding a similar proxy P ratio of competitor might be difficult. And also one more thing. If a company that you are planning to acquire is an unlisted company, okay, an unlisted company, and the proxy is a listed company. So obviously, using proxy P ratio, using proxy earning yield, whatever share price will you come up with will be a higher share price because it's a listed company having better marketability of shares, having better ease of selling the shares, hence more trust is placed by the investors. So whatever share price you are getting by using proxy PE ratio or earning yield will result in a higher share price for a company which is similar but an unlisted company. So you need to reduce the share price. For that, adjustment will be required. Okay. Now these were the ways through which you will work out the share price, like cash based method, which includes discounted cash flow, DVM, asset based valuation, earning based. There are other valuations that you need to do for preference shares. Now it's the same formula but rearranged now. Now you are calculating the share price of preference shares and KP will be given to you. That's the change in the mindset. Coming towards debt. The debt calculations of market values now will be relevant. KDs will be given to you, but remember all those KDs will be before tax here, before tax. Okay? And you need to work out market value, market value, market value is what you will work out. Okay? So for irredeemable, the formula will be I divided by KD before tax. For redeemable, the formula will be present value of interest and redemption amount. For convertible, present value of interest and convertible, higher of between conversion and redemption value. So the point I want to make is, main thing is interest, whatever you take in this calculation will be before tax. The KD that you'll be using for discounting purpose will be before tax because it's investor's perspective. So two things. If you want to determine is it a WACC question or a valuation question, simple tip is if KD is given, KE is given, KP is given, so it's a business valuation question because you need to work out the prices of that. But if share prices are given, market values are given, so it's a question of WACC because they will ask you to work out cost. One. Tip two, if KD before tax is given, before tax. So remember, you need to work out market value, and it's a business valuation question. Because before tax KD is a sign of valuation, after tax KD is a sign of WACC. Uh, and obviously, the other information you will also read that what you need to work out. So I have made it very simple and clear to all of you. It's now time to start with a Section B question. Are you ready, everyone? Certain good unique tips for Section B. Section B is a scenario-based question with scenario followed by 5 OTs. So actively read the scenario. The problems, the issues my students are doing, they are not reading the scenario properly. They are not giving importance to the scenario. Remember, information in the scenario must be used to solve those 5 OTs. Number 2, rounding off questions. Fill in the blank questions. Fill in the blank questions are important. So whatever questions you have in form of fill in the blanks, make sure you do consider those fill in the blank questions, because any small rounding off mistake will end up losing the marks. Okay, will end up losing the marks for you. So make sure you are not doing a mistake and you are considering the uh, the rounding off instruction, round off to millions, thousands, and all. Okay. then third, complete in 18 minutes as per normal time management. But how to do it? So I'll tell you few important techniques. Number 1, start with easy MTQ first. There are 3 scenarios in the exam. Start with a scenario that offers you the easiest solution. Start with that. Okay. Because if you start with your strength, you will take less time, and the less time you take, you will save more time for the difficult scenario based MTQ. Number 2, the one that you have started with, the easy MTQ. Okay, remember, in that MTQ, at least 2 would be the easy ones. At least 2 will be the easy ones in that particular question. The one that you started, there are 5. The sequence is not a problem in Section B. You can do the last 2 first and then come to the first 3. So the one that you chose to start with, in that also there are easy OTs first. Solve those easy OTs first, because those 2 will give you 4 easy marks. And to pass, you need 6 marks out of 10 in one scenario. 6 out of 10, which means only 3 OTs should be corrected to pass in one MTQ. So 2 are the easy ones. You will grab 4 marks. 1 will be a easy to moderate one. Solve that, grab 2 marks more. Even if you're not able to solve or get marks from the remaining 2, you at least get 6 out of 10. And imagine getting 6 out of 10 in one case study, the same in second case study, the same in third case study, means 18 you will score out of 30 in Section B. So minimum 18 you are targeting here in Section B. And imagine if you pass in Section B, if you pass in Section C, if you pass in Section A, just pass, you get 50. Halas. That is what my agenda is. That is what my effort is, that grab easy numbers first. So I hope the technique that I mentioned is useful, and let's do a rehearsal by solving a question. Okay. Let's start with this question. Let's read the scenario actively. J company holds diversified investment portfolio. J holds equity shares in L company, which is expected to pay a dividend of $0.6 per share in the near future. So please highlight all numbers, percentages, and certain key facts. Like this is a key fact. It will pay a dividend, okay, in the near future. The company is planning to undertake a large investment in the near future and as a result expect future dividends to increase by 2% per year. Okay. The company has a KE of 11%. Now, cost of equity is given. So it is a very high chance that something of business valuation will be tested here. Right? Now, the company holds 7% convertible loan notes of our company. So see, it's an investor business. It is very clear right now that J has made investment as an investor in different companies or planning to make investments. So in L, they have equity investments. In R, they have made a debt investment, which have a current market value of $97.5 per 100 loan note. It makes a lot of sense now. They are working as an investor, investing equity somewhere, investing debt somewhere. The loan notes can be redeemed at a premium of 15% to the nominal value in 5 years' time, or can be converted on the same date into 20 ordinary shares. Very nice, very simple. I understand the theme behind the question. Third, J has invested 10% preference shares in B company. This is a third investment done as an investor, which has a nominal value of $2 per share. Okay. The total nominal value of investment is 20,000 and the annual dividend has just been paid. So it is important to determine whether dividend has been paid or hasn't been paid, because it is important for X and cumulative dividend prices. The cost of capital of the preference shares is 8%. So because right now it's the investor capacity of J company making investment in preference shares, equity and loans. So KDs and KPs and KEs should be given. See, makes a lot of sense. And you might be required to work out the prices. Let's do it. Dividend growth model. What should be the current share price of LCO? So let's work out the LCO share price. Okay. The first paragraph is relevant here. Okay. Now, question number 1. And this stupid is not working, as always. Okay. Now, question number 1. I need to work out the share price as per dividend growth model. So, it's very simple. What is given to me? The company is expected to pay a dividend of 0.6. It hasn't paid yet. Okay. So, this is my D naught. I will grow this by the growth rate of 2%. Okay, this is my D1 divided by cost of equity of 11%. Okay, minus the growth rate, okay, which is 2%. Now, what price I am getting here? Guys, the price that I'm getting here is 6.8 per share. As per the formula, 6.8 per share is the price. Is that right, everyone? Now, what is the question? The question is current share price, which means the price right now. So, DVM assumes ex dividend share price always. So, it will provide you ex dividend, which is 6.8 based on future dividends. But because they're asking you current and dividend hasn't been paid, which means this is your ex dividend share price. I need to add current dividend into this of 0.6 to make this cumulative dividend share price. And this was the biggest mistake students did. They opted for 6.8 quickly and they were like, we have done the correct one. No, because dividend hasn't been paid. This means this share price will be this share price will be cumulative dividend share price. So what you have worked out through DVM will be ex dividend. You need to add the current dividend that they will pay to make it cumulative dividend share price. So the answer is not 6.8. This is 7.4 only because dividend hasn't been paid. See, conceptually, you should be strong to understand the words. What conceptual thing says. Easily one could have selected 6.8 but would have been the wrong answer. Clear? Yes? Done? Okay? Okay. Understood? Right. So the answer is 7.4. The answer is 7.4. Everything I've done as per the normal DVM, nothing different. The share price I got is the answer in every case. But because this case is different, because this is a case where dividend hasn't been paid yet, so the rule, the logic says when the dividend has not been paid, the share price in the market is known as cumulative dividend share price. That share price includes the portion of the dividend that yet to be paid. Okay? Yet to be paid, and that is why we'll include that in the share price. Clear? I hope clear, everyone. Next. Which three of the following, obviously three statements will be the answer. Which three of the following can be problems when valuing shares using dividend growth model, DGM? Problems of DGM. You have to find out the genuine problems of DVM. Genuine problems. The first one. Genuine problems of DVM. Number one, it may be difficult to decide on the value of future cost of equity. First statement, it may be difficult to decide on the value of future cost of equity. Number two, the model does not take into account the effect of share repurchase. Companies may not have sufficient cash available to maintain constant dividend growth. The cost of equity may exceed dividend growth rate. The model uses profits rather than cash flows to calculate share values. Okay. If dividends have not been paid in the past, the model cannot be used. Okay. Now I'll start with a reverse order. I'll start with a reverse order. Okay. Why I'm saying this? If dividend have not been paid in the past, model cannot be used is a wrong statement. Please don't be hyper. Read what it says. DVM is not useful when the company is not paying dividend in future, not in past, because the formula is designed in such a way that it considers future dividend. D1 is what? Dividend in 1 year's time. So even if a company hasn't paid a dividend in the past, but it will pay in future, DVM is useful. You can use DVM. So the word here is in the past, which is making this statement wrong. And because this is wrong, this is not the answer. This is not a problem of DVM. This would have been a correct problem if it says future dividend. So this is wrong. This is not the answer, okay? The model uses profits rather than cash. No, this is a wrong statement. Model uses cash. Dividend paid means cash payment. Dividend payment is a cash payment. You have cash, then you pay dividends. So it considers cash payments. It considers dividend, which means cash payments, not profits. So this statement is wrong. This statement is wrong. So this is not the answer. This is not a problem of DVM. Okay? Because the statement itself is not correct. Then the KE may exceed dividend growth rate. This is not a problem. Problem will be when growth rate exceeds KE. When growth rate is more than the KE, then you get a negative answer. But when KE is more than dividend, how this could be a problem? This is not a problem. Are you with me? No. No. KE is greater than growth rate is a normal scenario. Problem would have been if growth rate would have been more than the KE. So this is also wrong. It's opposite written. This is not the answer. And now, for sure, first three will be the answers because the last three are not the answers. I always say smart technique says filter out the wrong ones out of the box ones. If you read and find out that these can never be the answer, automatically you come close to the answer. Okay? Let's understand why these are the answers. Why these are the problems of DVM. Company may not have sufficient cash available to maintain constant growth rate. Yes. If company doesn't have cash available to pay dividend, so they cannot maintain growth rate because dividend is paid through cash. If you don't have cash, how can you maintain growth rate? And if you cannot maintain growth rate, DVM will not be useful. You cannot use DVM because DVM is dependent on the assumption that either the dividend will grow or will remain constant. So if you don't have cash to make it constant, you are challenging its one of the key variable of its calculation, and hence you cannot work out. Okay? Clear, everyone? Okay. Second, the model does not take into account the effect of repurchase. Yes, this is a problem. What is repurchase of shares? The company buy back its shares. So once a company will buy back its shares, what will happen? Your dividend per share will increase. Like for example, if you want to pay a total dividend of $100 and you have 20 shares. So 100 dividend divided by 20 share means 5 per share is the dividend. Okay. Now if a company buy back its shares and from 20 it comes to 10, from 20 shares it comes down to 10 shares, but will pay the same amount of dividend of 100. Now if you pay 100 again and the number of shares have gone down from 20 to 10, from 20 to 10, which means now per share dividend will be 10 per share. 100 divided by 10 is 10 per share. So what happened? Your dividend per share went up. Dividend per share went up. Okay? And if dividend per share will go up, your share price will go up. Because your dividend is the numerator of the formula, right? This goes up, so the share price will go up. Understood? So yes, the model is not taking into account the repurchase effect. Lower number of shares, if you pay the same dividend in total, if you pay the same dividend in total, so per share dividend goes up and hence share price goes up. So yes, it is not considering this. Done? First, it may be difficult to decide on the value of future cost of equity. Yes, future cost of equity. You need a KE for the calculation of share price using DVM. And KE is an estimate which may be wrong. Normally, we come up with KEs using CAPM in this case. CAPM means beta. Beta is a estimate. So yes, determining the KE in future or future KE might be difficult. Okay? So these are the 3 problems of DVM usage. So the last 3 were out of the box. Automatically first 3 will be the answers. But technically you should understand each and every statement. Everyone, yes or no? Next. What is the share price of our company? What is the share price of our company, R, at which J will be indifferent between converting and redeeming the loan notes to the nearest $0.01? See, J is an investor, have made investment in R. What the question is asking, what will be the share price where J will be indifferent, which means J will say, okay, I can even redeem it, I can even convert it. I can even redeem it, I can even convert it. I am indifferent. So very simple to work out, but people really faltered in this question. They didn't understood the requirement. This is the problem. not understanding the question, not getting clarity about the question. So listen, indifferent situation means what? Indifferent situation means you go with redemption, you go with conversion. Both are same. So what is the situation where investor will say, okay, I'm indifferent, either I can even go to redemption and conversion, it will not matter to me. When redemption is what? The redemption will be 15% premium to the nominal value. Okay? Which means 100 into 1.15, 115. This is the redemption amount. Okay? This is the redemption amount. Clear? Now, if conversion value and the redemption value are exactly same, if redemption is 115 and conversion value is also 115, shareholder will be indifferent. For shareholder, it will not matter either to redeem it or to convert it. So if the conversion value, understand, conversion value is same as the redemption value, shareholder will be indifferent. So can I work out conversion value? I cannot. Can I work out redemption value? Yes, I can. Redemption will be 15% premium to par. So this is my redemption value. If my conversion will be same, shareholder will be indifferent. Okay. Which means my conversion value should be equals to redemption value. I have redemption value. I can work out conversion value because to make it indifferent, both should be same. Okay, done. Now, what are they asking you? Share price. Every bond will be converted into 20 shares. So what they need is a share price, right? So if redemption is 115 and conversion value is also 115, what will the share price? Divide this with 20 shares. If conversion value is 115 and you will get 20 shares, so what will be the per share value? 5.75. 5.75. People badly faltered here. They didn't understood the question. Question like these are making life difficult. That is why read it, understand, absorb what they are saying. And see, you have done this calculation before, the higher of value calculation. But they asked here in a different way. Problem is English language. Problem is not understanding the question. Are you all with me? Awake? Yes or no? So indifferent means redemption, conversion will be same. And if redemption is 115, conversion will be 115. 20 shares are given per conversion bond. So the per share value is 5.75. To one decimal place, sorry, to two decimal place you have to present the answer because 0.01. So two decimal place. 5.75. 5.75 is the answer. Okay? Are you with me? Hello? Or I'm alone only here? Say something, yaar. Done. So this is the value. Okay. Next, what is the current value? Current. What is current? Value of total holding of preference shares in B company to the nearest dollar. Current value means what? Market value. Market value of preference shares. The market value of preference shares that J is holding in B. Okay. Let's work out. J has invested in 10% preference shares. Okay. The nominal value is 2 per share. Okay. Total nominal value of the investment is 20,000. Okay. Annual dividend has been paid. Okay. Preference share capital is 8%. Okay. Now, what needs to be done? See, first I need to work out the current share price. For current value, I need current share price. So I'll work out the preference share price using the normal formula of D divided by P naught. What is the dividend percentage? Okay, 10%. 10%. So 10 into the nominal value of 2. People do this mistake a lot. They do not consider the nominal value. Nominal value is 2 here. 10% into nominal value per share divided by KP, cost of preference shares. Okay. If you took this wrong, your answer will be wrong. Nominal value here is not 0.5. It's not 1. It's 2 here. Written very clearly here. 2. Okay. So the answer is 2.5 per share. See, it's a business valuation question where you have to work back and find out the share price. KP is given to you. Now calculate the share price. Okay. So current share price of preference share is 2.5. Now, J company, total investment is $20,000 nominal value. Per share value is 2 divided by 2 into the market value is 2.5. So the answer is 25. Now you have done this calculation a lot when you are calculating overall market values of the preference shares in WACC calculations. But here, the way they ask you is in a different way. So first you are required to find out the share price, preference share price. Preference share price. Okay. Then the total nominal investment J company has done is 20,000 divided by 2 nominal value per share into 2.5. Okay. So the investment done is 25,000. Clear everyone? Yes or no? What I personally believe, it is the way of testing that is different. That you have to understand what they're asking you to work out. Okay? So I think this is done, manageable. Last, the company would like to confirm his Jay would like to confirm his understanding of the terms and theories he has been reading about factors which influence market price investment. Which of the following correct? Fundamental analysis is based on the existence of patterns in past share prices. Okay? No. future dividends, not past share prices, future dividend. Fundamental analysis is based on future dividends of the company. It's wrong. The word correct is future expected dividends. Basically is used for fundamental analysis. Okay, like DVM does it. So that's wrong. Random walk hypothesis is based on shares value being unchanged when new piece of information is available. Totally wrong. Random walk theory says due to the availability of new piece of information, share price will change. It says unchanged. What stupidity is this? Random walk says once a new piece of information is available, share price will change. So this is wrong. This is not the answer. Okay. This is wrong because it says past share movement. Wrong. This is wrong because it says no new piece of information. Sorry, share price will not change. This is wrong. D. Technical analysis is based on identifying features within the company that will influence share price in future. No. Technical analysis is an analysis of the past patterns in share prices. Past patterns, not features within the company. It is not dependent on internal factors of the company. It is not dependent on features within the company. Okay? In fact, it focuses on past share price movements, past patterns. So this word is wrong, identifying features within the company. No. In fact, it should have been past share price movements. This is also wrong. So fourth is wrong because of this mistake. Second is wrong because of this word. First is wrong because of this word. Okay. In fact, this existing of patterns in past share price is actually technical analysis. Okay. Finding the patterns of that. This is the answer. Noise trading is based on the belief that stock market are inherently inefficient. Yes, because in efficient market, there will be no abnormal changes in the prices. Noise trader are those that without any logics, without any rationale, they trade based on humors, based on herding, like everyone is doing, okay, let's do it without any rationale. And they trade in the markets based on the assumption or the belief that stock markets are inefficient. Okay? So yeah, inefficient. Inherently inefficient, this is the correct one, that stock markets are inherently inefficient. That's why the behavior is like, okay, the share price will change, the stock market will react based on their irrational decisions. This is the correct one. All the three were not correct. Read it carefully. Read it carefully. Understand it. Translate in your local language and say, okay, is this close to my concept? Yes, no, wrong. Filter out the wrong ones. Automatically you will be at the right one. That's smart paper technique. All right then. That's the end, everyone. I hope day one went well. Share your feedbacks. Useful? Enjoyed? 0.5 is the current dividend. So for DVM, we always take dividend in 1 year's time. Okay. So company has declared the dividend, haven't paid it. So they will pay right now 0.6. But for DVM, we grow it 1 year later. So that is why we'll grow it. Okay. Payment. Everyone, quick feedback through your emotions, emojis. Today's session, how it was overall. I did cover CRQ, Section B, theory, calculation, spreadsheet, smart techniques. Do you like it overall? The way I tackled the questions, the techniques, the tips that I gave you, I followed it. Smart techniques. Liked it, everyone? Yes or no? So we did revise things. We did cover things in terms of practice. I hope all these things will be useful, will build your confidence. We will continue the momentum tomorrow. Will more practice, more revisions. Payman, is it clear to you? Because in the formula we take D1 always. We have to grow it. Okay? This is not future dividend. This is current dividend. We will grow and make it future dividend. I hope this is clear. Thank you very much, guys. See you tomorrow. No, not tomorrow. Day after tomorrow. Day 2 of FM webinar with more energy, more practice, more revision. See you then. Take care.